The S&P 500 trading near all-time highs, and there seems to be more room to run for it, at least according to a few Wall Street strategists. A handful of firms boosting their year-end price targets for the index, with Goldman Sachs pushing theirs to 5,600, up from the prior 5,200. And Evercore ISI now has the most bullish bet on the street, pushing its target to 6,000. So with signs showing inflation moderating and analysts increasingly optimistic about where stocks are heading, what should investors do next? Joining me now in studio is Tom Hayes, Great Hill Capital Chairman and Managing Member. Tom, the potential for the S&P 500 to go to 6,000. How should investors be positioning their portfolio amid a lot of this bullish optimism?
Well, Alexandra, I think that the Fed now has covered a cut. Okay, you saw some weakening inflation numbers, flat month on month with the CPI, negative 0.2% with the PPI. Unemployment was up to 4%. So they can move. You're looking at the Fed funds futures with a 65% chance of a cut in September, 95% chance they're going to cut by December, and a 65% chance that they're going to do 2 cuts by December. And I think the reason that's so important, Alexandra, is that you've seen such a concentration in this rally with NVIDIA, with Microsoft, with a few others. And I think the second half, what we're seeing is those earnings are going to broaden amongst all the other companies that have kind of been left behind. And we're going to see some more participation in those laggards, which represent great value, are going to start to outperform in the second half.
So you mentioned the probability that we'll see interest rate cuts in the fall, maybe 1, maybe 2. Yeah. Given that, is now the time to load up on interest rate sensitive areas of the market like small caps, or are there other areas of the market that you're more bullish on?
I think you hit the nail on the head, Alexandra. I think you want to be in small caps. I think you want to start to look at REITs. I think the other thing that people are overlooking is that as of June 1st, so just a couple of weeks ago, the Fed is now back in the market replacing $35 billion a month of treasuries. That's $420 billion of additional liquidity for risk assets. So before, that money had to come in from private markets to absorb that $35 billion of treasuries that were rolling off. Now that $35 billion is going to get pushed into risk assets, which creates a further bid for equities into year end. And I think, again, we could see a situation where the indices remain relatively subdued, maybe up a little bit more from here, like you see some of the targets, but not overwhelmingly up. But some of the stocks under the surface, like small caps, like REITs, like some of the cyclicals that have really been left behind, anything with leverage on its balance sheet has been trading like death. The market is so scared, are they going to be able to refinance, which has a lot to do with small caps, a lot to do with cyclicals. I think once they actually see that cut or 2 cuts is going to happen, credit markets are going to open and you're going to see these stocks absolutely rip into year end. Yeah. And that's where the exciting opportunity is.
Okay, so positive on small cap names. What about any areas of the market that you would avoid at this point?
I would avoid chasing the shiny objects. Okay? So I might be fading this split in NVIDIA. I know that's an unpopular thing. You know, the bulls will say that it's very reasonably priced because you're expecting 45% long-term growth rate, and it's trading at a 45 times multiple, which is only a one-time peg. However, you have to believe that assumption that they're going to retain 70% gross margin, that they're going to retain 45% per year growth in order to say that it's cheap at these levels. And that's simply not going to happen. I mean, one of the picks that we're going to talk about is Intel. That's received over $45 billion from the US government in terms of grants, tax subsidies, loans to create a competitive foundry to Taiwan Semiconductor. And that stock, you can't give it away at $30. And X the foundries, the legacy business alone, the PC refresh, the server refresh is worth $45 to $50 a share.
And I want to go back quickly on rate cuts because the Fed's only going to cut if we see inflation coming down. But there's a distinct difference between prices coming down and the rate of inflation coming down, which I think can confuse consumers a little bit. Yeah. You said in your notes that there's no way prices are going back to 2019 levels.
Yeah.
Why not?
You know, we all wish that. The only way you could get there after printing $6 trillion of money or increasing money supply by $6 trillion would be a deflationary depression like we had in 2008, 2009, where you actually have default and a contraction of money supply. What the Fed needs to see is just a slowing of the pace of price growth. And we're certainly seeing that. As a matter of fact, if you back out owner's equivalent rent and auto insurance, which finally we got a negative print, which we were all like, all the bulls are like, thank God, right? We've been waiting for this forever. Now we just need to see owner's equivalent rent. You back those two out, headline inflation is at 1.83%. So they should be at the point, this was kind of like a hawkish rhetoric this week that kind of threw the markets a little sideways for the stocks that are not called NVIDIA. I think we're going to start to see more of the speakers come out now that they're out of the quiet period and start to give us some expectation that even if Kashkari, who's been Mr. Hawk, saying, yeah, by December you'll get one, and then some of the more moderates coming out and saying maybe one, maybe two, we get some more data, I think that whole group of left behind stocks are going to really, really rally. And that's where the money's going to be made in the second half.
All right, awesome. Great to get your insights, Tom. Thank you so much. Tom Hayes, Great Hill Capital Chairman and Managing Member.
My pleasure.